I'm recording, by the way. Sorry.
I'm kidding.
I'll give you a minute.
So the carriers that are left insuring in Florida, they've been instructed to reduce the amount of coverage that they deploy in any given year. So if carrier A had 500 million, now it's down to 300 million, right? So we have less carriers and less capacity. So it's causing carriers to give less limits on renewal, and inflation is also hurting the market because carriers are paying based off of today's cost to rebuild, cost of building material, cost of labor, right? If a claim occurred, they're paying today's prices. And then I saved reinsurance for last because reinsurance is the insurance that carriers purchase, right? That carrier that has $300 million of coverage, they only take the first 100 million and then they buy reinsurance for the next 2. Reinsurance has been going up for the last 4 years, but reinsurance is the sole reason that we're seeing the market actually worse than it was last year. Reinsurance renewals just passed January 1st, and it was worse than anybody's seen in this generation. The rates for the carriers, reinsurance went up anywhere from 70 to 200%. So carriers pay more. They don't absorb the cost, right? They pass it down. They pass it through. So we'll see a slide on reinsurance. Cat losses, right? First one we talked about. This is just the United States alone in 2022. We had 18 separate billion, with a B, billion-dollar weather events. 2021 was actually a little bit more, 21. So the outlook for 2023, and we talked about it, reinsurance. These are a couple articles, saying that reinsurance rose as much as 200%. Reinsurance also has capacity issues. They were saying that about $60 billion of shortfall, right? Meaning that the reinsurance capacity that was deployed before, now that's shrunk. So all those factors are what's affecting the market. Okay. So your current property carrier, right? Property is the largest premium policy for Quantum. Okay. Your property policy is with a carrier that doesn't need support, right? They can do the full limits. They buy reinsurance as well. They have reinsurance issues and capacity issues. So this is not your renewal, you're going to see on the next screen, but this is a recent renewal that we had for a building similar age and location. Okay. This condominium, their expiring limit was 111 million. Their expiring rate was 49 cents. That's 49 cents for every $100 of coverage. And their premium was $546,859. At renewal, they got a new appraisal. The appraisal went up 10%, so it went to 122 million. The rate went up 82%. The same carrier, and the rate was 89 cents. And it was just over $1 million, or just under 1.1, which combined, remember, because the premium is your limit times the rate. That's all it is. It's 2 variables. So when you multiply those 2 together, it came out to about 100% increase. Now, that's just the premium. Then we look at the terms. The hurricane deductible for that building was 3%. The renewal went to 7.5%. The hurricane deductible was on a calendar year, meaning no matter how many storms, you have 3%, right, which is roughly 3.3 million for this building. That was the deductible no matter how many storms. Well, they were changed to per occurrence, each and every storm. And then wind-driven rain went down from 500 to 50. So again, this is not Quantum's renewal. A case study, right, of a recent March 2023 renewal for the same carriers. This carrier is not releasing terms to start negotiating until 20 days before renewal, which we're almost there. But just for reference, this is Quantum's property policy. This is for all 3 associations. Okay, the building value is 132.8 million. It's a 5% deductible per occurrence. So it's already kind of in line with this. And the rate is 75.9 cents. Now, I think it's important to note that this renewal, although we are the current broker, we did not have time to negotiate it, right? So I think that with time and being the incumbent, that we will secure the most favorable terms, right? Because, and I say that because at 49 cents versus the 75, right? There's other factors like claims that have to be taken into consideration, but we would look to secure terms, hopefully for full limits, but at a not at 100% increase rate or 82 cents or 82%. So strategies, what do we do as far as strategies, right? So education, holding town hall meetings like that, meeting with the board, meeting with management, having multiple meetings, talk about the changes. This market seems to change week by week, okay? As we get closer to renewal, continue to have update meetings with progress of kind of where we started, where we're going to finish, not just to come in a day before renewal. Risk consulting, building a program specific to quantum, right? Every association is different, risk profile, claims, et cetera, et cetera, et cetera. Building out a standout submission. In years past, you just sent a standard application that didn't really say much, the appraisal, and then this Excel spreadsheet. Those days are over. Carriers now have a stack of submissions. How do we make it stand out? Writing the narrative, writing what the building has done, how proactive management and the board are, right? Projects that have been completed. So, and then as far as our strategies, right? You have carriers like we have now, which is one carrier providing coverage for the whole building. There's very few carriers that can do the full 132 million. Okay, that's one of them. Citizens is another one, which we'll talk about on the next slide. And then there's this shared and layered where you have to stack carriers on top of each other, $10, $20 million at a time until you reach the full limits. Now, when I met with the board and management, we talked about Citizens. Citizens does have some requirements, right? They require a different type of appraisal. They require roof conditions report, which is pending, and then pictures of the roof as well. So we did secure a Citizens compliant appraisal. Now remember, we're at 132 million. The Citizens compliance appraisal doesn't allow the appraisers, right, the licensed appraisers, to change any variables. And if you see here what the valuation for Citizens came in at, it's just under 200 million. It's a significant increase, in valuation. It's about $60 million, $65 million more. And remember, it's value times rate. It's a premium. But we did get rates for Citizens. Citizens is wind only. And they're actually very competitive. Your same deductible 5%, it's at under 70 cents. 70 cents for every 100. So that premium came out to 1.38 million. Now, again, I put this here just for reference, but we have two routes to go, two strategies, right? One is Citizens, one is the non-citizens, right? And we have to look at every viable option, right? And bring multiple carrier options and multiple deductible options. So I know I'm trying to go fast, but I think I might still have more time.
Okay, you have 8 minutes.
8 minutes? Did I have 8 minutes total?
Now 8 minutes is me. No.
Okay. Well, I got to the end because I was talking really fast. I'm sorry, I normally talk slower. But if anybody wants me to go back to any of the pages and elaborate a little bit more, I'd be more than happy to do that.
How many claims have we had
We've had a few, I don't have it in front of me, I mean, we're,
We only.
yeah,
And you
right,
have one.
3,
Is
maybe.
that affecting the premiums?
One of them is a flood, right, so it's not property, which you're talking about now. As far as the other ones, they are not, the 6, 7 figure claims, at least as of yet, right, but I don't think it's gonna get there, but Emily and I have been speaking about it. Claims used to, in years past, affect the roads, right? If you had if the association had a dozen claims a year and they were 6 figures, I would say it affects the rate. But the rate is driven more this year by reinsurance, the cost of the insurance that carriers buy, and those other factors I talked about on the wheel. The deductible, the claims, and the majority of them are water damage claims. The claims are more so going to affect the water damage deductible, right? The more claims you have water, they're gonna look to increase that deductible. So the current deductible is 25,000, right? So if there are a lot of claims, that could go to 50. There are some buildings that I've run across that are at 250. They have systemic water issues.
Question. Do you guys have anything to do with the wind mitigation report? Which requires the building to have kind of an updated wind mitigation?
Yeah, so good question. So with Citizens is the one carrier that requires a wind mitigation report within 5 years.
And would you know if we have that one? Because the reason I'm asking is because last year I was with my insurance policy and shopping around some rates and some prices. Allstate offered me a very nice policy at a very nice rate, but they were asking us to submit the wind mitigation report. And the one that I got from management was 10 years, something like that. So they didn't want to take that, they were asking for 5 years.
Yeah. So last year with the carriers, I would call it the private marketplace, right? A-rated carriers. They don't require it for a building like Quantum, right? For Citizens, it doesn't matter. They require it within 5 years. Now the rates in the private marketplace have gone up substantially. We're now far past Citizens rates, right? So now we're seeing more buildings get an updated wind mitigation form. But I would just warn you that even if we did have one, right, last year, your carrier still might require you to get one to list your name and your unit number. Some carriers want to see the unit number, which the association mitigation form can't do. You would get the same thing, just a personal one. It's like $125 to get one. So.
So Sean, our current insurance carrier will not give us a quote until 20 days before expiration.
20 days before expiration, and unfortunately, if 20 days falls on a weekend, they're not like banks and your direct deposit paycheck on Friday. They give it after.
So our policy is expiring around April 18th.
Yeah, on the 18th.
So that means we should maybe by March 29th, so within like 7 to 10 business days or days, should be able to get a quote from them. Is that correct?
Correct. And the 29th is on a Wednesday, right in the middle of the week. I've actually had a long drive to Naples and back today, and on that I called the underwriter a couple times and actually connected with them and said, please, I need on this date, I need keep it at the 5% as much as possible, right? Not to go to 7.5, but they're having issues with the 5%. So we're going to look at every option. Just even if they quote the renewal at 7.5%, right? Their pricing and rate can be significantly more competitive than the layered marketplace. This is where it gets really expensive. But we can complement it with another policy to buy it down. And then we'll see what the cost is.
So then, within the next 10 days, hopefully 29th, 30th, we'll have hopefully a quote from our current insurance carrier, right? We already have a quote from Citizens, correct? We know what that premium would be.
We have,
Roughly?
yeah, we have the quote from Citizens, we just need to upload everything to get it to the approval finish line.
Understood. And then the third option, which is the layered option, which is where you go to 10 different carriers, and this carrier takes 10 million, this carrier gets 20, this carrier takes 50 million, and you layer and stack them on top to get to our limit. When can we expect a reasonable estimate of that layer?
So to get a final of that, I unfortunately, because of how backlogged these carriers are, and there's so many moving parts to it, because we take it, move, and the structure changes about 25, 30 times. To get the final with the best, most competitive structure, it's probably a couple days before renewal. However, that's not the first time you'll hear about it, right? Starting, I would say about 3 weeks before, we're gonna start getting initial, especially the bottom layers, which are the more expensive. And, I'd like to have multiple meetings so we can show you, okay, this is initial on layer, this is out of the gate what our current carrier is doing, but that's just out of the gate. We're gonna go back and forth. Because I will tell you, with the other renewal that we had here, their renewal rate was over $1. And what we did was we said, look, Citizens rate is here. Okay, now they know Citizens is wind only and you have to add another 25 cents. But we told them it was there. What we didn't tell them is the value, right? Because increased value is going to offset the lower rate. But we use the lower rate to ultimately get down to the 89 cents.
So now these 3 weeks that you mentioned before is roughly 21 days, so it falls in line with at the same time that our current carrier will be providing some numbers. So within the next 10 days, by the 30th, 31st, we should have at least a first glimpse at what we're facing. Is that correct?
Yes, that's correct. And we're going to push the carrier to hold to their 20-day mark, right? This new guidelines that just came out this year, their 20-day mark, and try to get as many carriers, even if it's indications from them, as many layers as possible. But I will tell you that 3 weeks out, it's not going to be close to the 132 million.
Correct. But at least the first few layers we'll get, and I'm sure through your experience, you can, in some fashion, estimate if the rate for the first 10 million is X, rate for the next 20 million is Y. There is some level of predictability you can apply to give us a range of our expected increase. Is that correct?
Yeah, I can make the predictions on those higher layers. However, I will tell you, because we have less carriers, and when reinsurance skyrocketed, even more carriers said it's just too expensive, right? There are a lot of buildings now that are already in shared and layered that can't find the capacity to finish.
Okay.
Right? So even if we predict it, it might come to a point where it won't even finish.
I do want to ask one last question. It's a question I want to ask every single insurance broker. So first of all, thank you for coming. I want to ask you a strange question, but how can we increase the competitiveness of our building to ensure that we get the lowest quote possible? How can I bring in a competitive broker, which is actually, as you know, coming after you to speak to us, 2 of them actually. How can I work with them to apply pressure, to do whatever it takes to get to the level of competitiveness? Can I do that within the insurance market?
Sure. So it's a good question. So again, the different ways to go about it, right? The current carrier, if they provide full limits, it's a single carrier solution, right? Then you have Citizens that can do the full wind limits, right? Which is good. That's the hardest thing to do. Now, Citizens is the only carrier that will allow 2 brokers to quote, but it's going to be the same exact quote, right? So it's a moot point at that point. It's really who's going to shepherd the process to get the formal quote. Now, when you go to the shared and layered, that's where it's going to get very muddy to bring in multiple brokers. And I'll tell you why. Let's assume that we can do the full 132 million, and you need 10 carriers, right? But the pool of carriers is only 1 through 20. And if you take the 1 through 20 and you say, okay, broker A, you get 1 through 10, broker B, you get 11 through 20. Okay, but the optimal, most competitive structure is 1, 3, 5, 11, 15, a little bit of both. If you split it, you're never going to see what that most competitive option is going to be.
So the
So
reason is that the carriers will not work with multiple brokers, and they will not work with 2 or 3 brokers at the same time. It's one broker only, and we decide who is that broker.
correct. So yeah, that's correct. Every carrier is like that, and will only negotiate and work with one broker at a time. Citizens, which is the state-run insurance company, will give 2 quotes, but they're going to be the same. So in essence, it's really one broker.
So having multiple brokers work at the same time really does not seem to be a viable strategy in the insurance industry. It may be great when you're buying a car, but it may not be the wisest choice when you're getting insurance.
In Florida, no. In Florida, no.
Thank you, Sean. I want to be conscious of your time.
Do you want me to
Yeah.
just hit eject
Yep.
for you?
You want to do it? You have most.
Okay. Oh, I gotta close this out. That's why. Can you press escape on there? There it goes. All right, thank you, everybody. Appreciate your time.
Thank you, Sean. Before I call the next person, everyone on Zoom, you must have your first and last name. You must display your first and last name on the Zoom meeting so that you can be properly identified. Thank you. We're gonna call in the next person. Thank you so much. I locked myself out. Okay. Here in the house, please.
That's that.
Yep, and we're gonna put you right here.
Perfect.
Yep, no, good, this right here, yeah. I don't know how to say this.
This may be slick.
Yeah. Share.
Good evening, everybody. Does everybody want to hit the wine already after having an insurance conversation, or? All right.
Did it do it?
I think it's
Yep.
okay.
It did. Okay, introduce yourself.
Perfect. So good evening, everybody. Thank you all for making the time here. I thank the board and also Emily for setting this up. So I represent Marsh McLennan. My name is Juan Jaramillo. I'm the vice president there. I work in the real estate practice there. So we do a lot of condominiums as well as the family and essentially property throughout Florida. Before I get started, I just want to do a highlight of the board and just congratulate them for the job they're doing to make sure they're doing their due diligence in this process. I do work with a lot of boards. Not every board can, is doing this thorough process. So, it's good to recognize that the board's doing their jobs, property managers doing their job. It's a very difficult market, but it's worth recognizing when you have a board that is working for you. So to get started again, so who is Marsh McLennan? Just don't want to assume everybody knows who we are. Marsh is the largest insurance in the world. So we service basically in 130 countries, as I mentioned. I am local in Florida, so our team is a South Florida local team. I help represent the real estate practice here locally. And in our model, essentially, we try to provide that local agency model to our clients, where I would be your point of contact for everything, very high touch service. But we get to leverage the power of being large. Bigger isn't always better, but what we've seen in these markets, when it's very difficult to get things done, the brokers that put the most premium in the market are tending to get the most leverage. So that's really where we're being able to derive a lot of our negotiating power on your behalf in the insurance market. So that's where that part has been very beneficial to us, as well as accessing programs and markets that maybe you can't access directly otherwise. So this is a highlight from Marsh's, and look, I'm sure you've already heard from my prior, industry peer, all the reasons why insurance rates are going up, and you probably don't want me to sound like that again. So of course, this is like a highlight of all the reasons why rates are going up, and the reason why things like the war in Ukraine and supply chain shortages all affect the market in Florida is because essentially all insurance comes from the reinsurance market at the end of the day. So there's a global reinsurance market where every insurance carrier purchases their own insurance from. So at the end of the day, you have wildfires in Australia, California, hurricanes in Florida, war in Ukraine. And it's before direct insurance carriers, but it all trickles back to the same reinsurance market. So it aggregates all the losses in that insurance market. So reinsurers have lost a lot of money in 2 years, whether the good guy, the bad guy, everyone want to see them. They've lost money, and they are unfortunately a for-profit business. So they've been pricing or adjusting their pricing as they seem fit due to the actual underwriting. And what that has caused is that there's a actual drop in the amount of insurance they're willing to sell. So this is the visual that in 2021 they sold over $568 million of insurance. Sorry, $1 billion of insurance, and they've actually decreased that to 530 over the last year. And the actual supply has decreased. And this is all happening in a market where valuations are skyrocketing. Just this building, we'll get into it, the valuation of this building itself went up, as well as every other building maybe, because the cost of construction has risen these costs. So you're requiring more. Demand is higher, yet the supply is low. So this is causing a lot of pricing pressure. Capacity, essentially capacity just means how much product is available in the market. So there's less capacity in the market. And overall, it's just a much more difficult market to navigate. Also, reinsurers are pushing more terms on their carriers, which means I will only write a building if it's after this year, 2002, for example. So I'm only allowed to insure buildings that are newer than 2006. I'm only allowed to insure buildings that have a roof that's 15 years or younger. Before, that was kind of like nice to have. You get a credit on your premium. Here's some benefit to you. Now, if you don't have that, I'm just going to insure you, and you have one less market available to you. So that's been the reality of the reinsurance market. That used to be a lot more malleable, how you can negotiate with carriers, but they've kind of put the hammer down on what they can and cannot offer. When we're talking about the losses, as I was mentioning, about insurance companies losing money, these are all the losses that we've had in the last couple of years. You can see consecutive years of $100 billion+ losses. And this is U.S. This is global. So there's 126 billion in 2020, 125 billion in 2021, and 136 billion in 2023. That's 3 consecutive years on top of what's happened in the past. And this is just a visual. I know they're kind of joked about it. Everybody's talking about this. This is from the National Severe Weather Report, NOAA, showing the $1 billion+ events in just last year alone. So this is just highlighting how many were just last year alone in the United States. Again, this doesn't even encompass the whole world. And I'm going to run through this and get into the part for your building quickly. But what I want to just highlight this, and I know it might be hard to see from over there, but essentially speaking, the last year we had $165 billion of claims. Before that, in a whole series of 10 years, you had maybe $500 billion of claims. So the amount of claims that were aggregated has been very substantial.
Yeah, just 1 second on Zoom, they can't see us go through the slides.
Oh, okay.
How about now?
Yeah.
You're gonna have to go
That's
through
perfect.
here,
I can do that.
okay? And just scroll.
Okay, yeah, it's not a problem. Yeah,
Remember, you have 20 minutes.
Yes. Okay, so I'm not getting into what to expect. I'm just gonna get right into how this affects quantum of events. So I got a chance to review the policies and actually update these numbers since I received the policies. So when I reviewed this in 2023, your total property value was $132 million. That's the value to reconstruct this replacement cost in 2023, or in your prior cost. You received an appraisal in February, and because of that appraisal, it's valuing your building now, the total building, at $197 million. That is a 48% increase in the value of your building, of your property. So that's how much insurance you should be purchasing this year to get full limits, if you want to get full limits as you did last year, right? So the way premiums work, it's a direct relationship between the amount of coverage you need times the rate. So if the amount of coverage you need to buy increases and the rate even stays the same, your premium still is going to increase. So what's happening this year, and again, I'm very upfront when I say what's going to happen with prices and numbers. I don't want everybody to be unaware when I work with somebody, is that you can expect at a minimum of 48% increase to buy full coverage this year. So last year, the total insurance spend, this is just for the property. I know there's other coverages, but property probably makes up 90% of your premium, so I want to focus on property. Last year, you spent about $1 million, just over $1 million in change on property insurance. This year, if you just get a flat rate, you don't get an increase from the market, you would be spending about $1.5 million, just short of that, on the property. So what do we at March propose to guarantee you guys your savings? Look, we have a lot of big portfolio, we have a lot of clients, and especially in the condominium market, this building hasn't changed, right? We're not insuring more property. Just because the valuation went up, we're not insuring an additional building. Yet brokers have been making more and more money as these increases can come up. And it makes sense, we're working really hard, but at some point there's a tipping point, right? At what point is your broker getting a 100% salary increase in that way, just because they insure the same building, right? So with a lot of our clients, what we're implementing is this fee-based structure, where we say, look, the pricing of the insurance market is being pretty ridiculous right now, and we're working with you to help mitigate that. But we need to put some skin into the game too. We understand that you as a client are suffering from this. I live in a condominium 10 streets down from here, and I can tell you my HOA is going up. We're all paying a lot more money, and I know it's because of insurance. So I know we're all feeling this, so there's a personal responsibility to do this, but there's also a responsibility to you as a client and our, as your broker, where it's we got to give a little bit too. So what we propose is that if we implement a $60,000 fee, the reason how that affected last year, just based on your property policy, there was about $164,000. Sorry, this year there'd be about $164,000 in commission this year, just based on a flat rate. $164,000 of commission. When probably 5 years ago, the commission was probably only $60,000, right? If we just put the fee right now with no rate changes, we would see about $104,000 savings guaranteed, just if the rates stayed the same. And that's not changing anything. I can guarantee you it will never be more expensive, but we are willing to understand that this is a market that's a little bit skewed towards insurance carriers pricing, and we prefer to understand that and offer you some value in the front end. But now let's take into consideration when the rate actually does change. And let's be generous with a 30% rate increase. It could be higher, potentially be lower than this, but let's use a 30% rate increase. So instead of paying about $1.5 million for property, you're now paying about $1.9 million for property insurance because of the rate increase. Here's where we can even guarantee you a little bit more savings. We're still going to take the same $60,000, and now the potential savings are about $153,000. And again, this is without changing anything. There's a lot more things you want to do to help improve your program, improve the cost efficiencies. But this is just to say, look, apples to apples, if we did nothing, just reviewed as is, and there was no changes, we want to guarantee you some savings by working with us because we think it's fair to you, it's fair to us, we're getting compensated how we think it's fair, and we're providing you the value you deserve. So that's just is there any questions on what that means? I know sometimes the way compensation is a little unclear, but I'm trying to be as transparent about it as possible. Now, moving beyond what we want to guarantee for savings and what our strategies we want to implement working with you, we have to implement these immediately as soon as we can start working together to help minimize these costs. So one of them is considering what we call a wind loss limit. So essentially, your $190 million property, we would do a actuarial study that will tell you, basically in the worst storm possible, what's your maximum loss that we can expect from a hurricane. And it could be roughly, $20, $25 million for the whole building. So typically what we can do is use that number and say, you know what, then I feel comfortable buying $40, $50 million of wind, I don't need to buy full coverage, because that's 70% of your property premium. So if you can still buy adequate amount of wind coverage, you feel you can sleep at night, but you're not having to, break the bank to buy full coverage, that's an opportunity to potentially save some money there on top of what we said about the commission. When it comes to the hurricane deductibles, it's moving towards having true catastrophic insurance, which means you're not gonna use a hurricane coverage for a small damage. You're gonna start using when you really have true catastrophic damage to your building. So considering 5, 10, and 15% deductibles, getting you what you have now, which is 5%, but also getting you options and seeing what the cost savings is and working with your board and the property manager to make sure to see if they make sense for you. The last 2 items to look at is the citizens windfall. So we do not like to have to put a client in citizens for all coverages, but your building is windfall eligible, which means you can get citizens for just the wind coverage. So you get a standard carrier that provides all the bells and whistles of property policy, and you get citizens for just the wind. So the benefit of that is you get the best of both worlds, where citizens can offer you great pricing, and you're only relying on one peril. You're not getting the crappy basic coverage, which is what they offer otherwise, and you still get the special coverage for everything else. And then also looking at potential solutions with, there's things called parametric solutions, there's other markets, and now that the US market has gotten so expensive, thanks to Marsh having offices in London and Bermuda, we can access those markets. It's not that they're cheap, it's that we've gotten so expensive that now those markets are becoming attractive. But we can access those directly, whereas another broker typically has to go to 2 or 3 brokers to get to those markets, but we get to leverage our local offices there. Just to give you guys what it looks like, so this is a PML study where I know it's hard to look at, but essentially this is saying in a 1,000-year storm, the max loss for this property, this is about $100 million property, that's a client of ours, it was about $18 million. So with this client, it made sense to buy $25 million of coverage. It was cost saving for them, it made sense in a cost benefit analysis, but we used the data to help back up that decision. When we talk about the other program, so what a wind loss limit looks like this, where essentially you have wind coverage, you might buy, you bought $20 million of wind coverage, and then you bought 100% of fire, means everything else except wind. So any other peril, any other damage, just get some wind, it's the only thing. So you build this tower. The citizens options, we have the citizens wind pool policy, side by fire policy. So this is kind of what the structure would look like. And that's just to give you a sample. So again, this is just a timeline that I proposed to your board. We would have to hit the ground running to work with you. So I understand there's probably a process behind for you guys to work on this. But I would like to just open up the questions. Again, insurance is the black hole. So if I can make it a little bit clearer, please let me know how I can.
So where did that $197 million amount come from? Appraisal was done?
Right. So every building, but for information, has to do an appraisal every 3 years. That's the law. So every 3 years you must do an appraisal, right? So when you did the appraisal, I compared to your numbers from last year to this year. So your numbers, the value of your building went up from 132 million to 197 million. So that's what the value is to replace. If the building came down completely, it would cost 197 million to completely rebuild it.
So that doesn't include land.
No, that's just the building. That's just the physical construction of the building. And then on top of that, there's a 30% increase in the market that we're, just using as a number. It could be higher, it could be less. So that's where the combination of increased value and the increased rate is giving you that number. Yes.
Now that particular appraisal, because I understand it was done specifically for citizens. Citizens has certain guidelines that the surveyor and the appraiser must fulfill to get to basically follow their guidance.
Correct.
If we did a non-citizen survey, would the number come in also at 197, or would the number come in as something more reasonable?
It'd be the same number. So the appraisal at the end of the day has to be, citizens doesn't have a specific appraisal form, so you still went to some public appraiser or private appraiser company that did it for you. And for citizens, it's just to get a bindable quote, you must have an appraisal done. So that's why you have to do it. So it's not that it's a citizen's appraisal, it's just an appraisal that you were asked to do for citizens. The other thing to think about is that now you and the board, you make this decision, say even if you can have the opportunity of not insuring the full $197 million, well, now you're taking the option, am I going to sub-insure or under-insure? So that's now that you did the appraisal, and now that number is out there, we know what the value of this building is. If you were to not insure for that full value, that would be a decision from you guys that you're not insuring for full value, right? And the other issue, a lot of policies have co-insurance, meaning that you must have at least 80 or 90% of insurance to get full coverage, otherwise you get penalized. So there's penalties for not insuring full value. So now that you have the appraisal, we're kind of bound by the appraisal. That's the number that got set. Yes.
Does common law in Florida allow us to buy less than 100%?
It does, and typically the issue that was around more in the past, but now it's become more understandable, is more from lenders. So you're allowed to buy less than 100%. Where we in the past got pushback from that, is like a lender might say, hey, I want to see you buy full coverage, because if I'm lending you, I'm a mortgage holder, I want you to see you buy full coverage. But here's the thing, we actually have a lot of banking clients, and we can presenting to them too, to understand what's happening in the market. And now lenders are easing on their lending requirements, because they're thinking it's either I get my loan paid back or they pay for insurance. It's it's one of those situations where now lenders are starting to accept the reality that full coverage in Florida and the Tri-County is not it's not always going to be possible. If you can get it and it's economically feasible, that'd be phenomenal, right? But now we're in a reality where full fire is still going to be expected, but understanding that having a loss limit on the wind is reasonable to lenders now. So that's more where the pushback came from the past, but it is legal. Yes.
So what if we were to insure the building instead of for 197 or less than 20% less, right? So let's say rounding just 160.
Right.
Would that cause any problems with existing mortgages and existing owners who have, obviously mortgages with various banks?
Right. So, and that's where I've spent a lot of time talking to banks the last couple of weeks, and a lot of times we'll talk on behalf of clients and we'll get ahead of it and help them explain what's happening. And again, this year has become more understanding. So I would expect the banks to really require full fire. That's still being expected. Meaning, you're going to do this, you're not sure 100%. I would expect them to require full fire limits, and then they will be more understanding on the wind side. So you wouldn't just buy 160 million overall. And again, keep in mind that the wind coverage is probably 70% when it comes to the property policy.
Yeah.
So it might not make sense to really cut down the fire.
Right. No, that's what I mean. I'm really talking about wind. And so the other my question would be: suppose we go ahead and we buy wind for 160. Would we be triggering in any way any type of covenants against mortgage, current existing mortgages, et cetera, et cetera?
Right. Look, we would have to look at mortgage by mortgage basis and who the bank is. But again, in my experience, it's become more common practice, so it's become more accepted. And that's where, again, that's why I had to step in along, having conversations directly with the mortgage agent, whoever they are. But I want to understand it's becoming accepted. Because it is.
What's the real possibility that you're gonna be able to talk to every one of the banks that we have for every bank? Not just the ones that we currently have, but the ones that are going to be coming.
Right.
So are you going to be speaking with every single customer that's gonna buy here? Or everybody that has mortgages, you're gonna speak with those banks?
I mean, like case by case, I haven't had every single mortgage holder is required to do this. I've had it done before where they ask for it. Yes, and some are, again, some banks are more lenient than others. Some are seeing it and just kind of running how they understand and they accept it. Some maybe aren't as familiar, maybe you have like a loan from a mortgage company that's not based in Florida. They're the ones that maybe push back on you a little bit more. But it's happening. I mean, the reality is that you guys wouldn't be the only building that's happening to.
I just want to find like certain things, this is important.
Yeah.
The law changed recently because it was my understanding that the law did not allow us to.
So I can tell you from my experience that it's happening, and you're going to be the only association considering it.
But then would we be fine?
You can
Just, yes.
yes, you can. Anything else besides that?
Any questions?
Any questions on Zoom?
Juan, thank you very much.
Hey, thank you.
Anytime. Thank you so much for taking the time.
You all want.
There's one that's all.
Yes, we have one more. Thank you, Brad. Well, we're almost ready for you.
Yes, please. Yes, thank you. Just put your, oh, actually, you're gonna be up here. You want those papers?
Yeah, I was gonna. Guess we. Maybe it's not now.
What is it?
Well, I can pull that later, but here's the first of the introduction.
Okay. Alex. Sure, hand them in.
Hello. Did you hand these out? Thank you so much.
Tell me which ones do I open?
The diagnostic person. Yes, they can have this up in paper and that is perfect.
This one, right? That's you?
Yeah.
Let me see. Hold on. Oh, that's green. Okay, come to this side. Okay, here you have your little mouse. You can scroll up and out.
Okay.
And you have 20 minutes to introduce yourself to my alarm that debate that you gotta get out here.
Okay, thank you. Well, thanks everybody for staying so late. I appreciate you having me. I'm William Deere from Brown & Brown Insurance. I'd like to talk a little about myself and the company, what we bring to the table, talk about our coverage audit for your current program, and then we close with a discussion on fee structure. A little about Brown & Brown Insurance. We were founded in 1939. From one office, we've grown to 450 offices. We have 15,000 teammates nationwide. We all have the same culture of, it's not about reviewing the insurance program, it's about first you got to understand the customer's needs. So what are the customer's needs? And like with Emily, I did a site visit here as well. So I met with her, did a site visit and asked about 2 pages of questions to really get a feel for what the needs are. We feel like once you know what the needs are, now you can look at the insurance program. And if you're lucky enough to be hired by the association, now you can represent them in the insurance marketplace and do a great job. So that's about Brown & Brown in the corporate culture. I think from the office standpoint, I'm from the Fort Lauderdale office. We got about 170 people in the office. We got 20 people in our condominium departments. I started doing condominiums back in 2009. I've been with Brown & Brown 9 years. We had 12 people in the condominium department I started. We have 20 now. We're growing pretty rapidly because we're doing a very good job, you know, winning new business and keeping the retention, keeping the condos that we do win. Some things that we have some value added service that we try to have besides the corporate culture of doing the site visits and having the marketplace presence throughout the year. It's like, if you guys have a vendor or a contractor, I would say, hey, let me take a look at that insurance certificate. It's not the property managers or the board members' jobs to see if the insurance certificate is fit for the scope of work. Let me look at it, make sure there's workers' comp, make sure there's liability. I always want to see that you're listed as certificate holder, additional insured, and I prefer to see a waiver of subrogation in favor of the association. And people might say, why do you need to see all those things? Well, I know I saw in your loss runs, you had that one claim, it was a $450,000 claim. And later on, they were going to have recovered around $300,000 from one of the vendors. What I like to do a little bit different is say, let's get the additional insured whenever possible. Let's not file with the association's carrier because we're never going to collect all the money from their policy. Let's file with a contractor or vendor first. With this, if they don't want to file it as additional insured, we can file it for them. Once the claim pays, I want the waiver of subrogation in favor of the association, so once that claim pays, they can't come back and say, well, I'm gonna look to quantum for contribution. No, we have a waiver of subrogation in favor of quantum, so just little things that you do throughout the year that can make a big difference. I just came from a community meeting. Once a year, we try to host a community meeting for the members. You got 600 plus owners here. We like to say, okay, the association's got property responsibility for it. We define that, and the unit owner starts from the paid in, and we define that. We give them, examples of how to quickly calculate what kind of property coverage they would need, and then we say it's not just about property. There's also liability covers. There's loss of use. There's loss assessment. And we talk about the wind deductible, how that can impact the unit owners. How could they collect that back from their carrier? So once a year, small stuff that you do that can help the association and help the owners out. So that's just some of our value-added services. It's a little bit about me. And if it's okay, I think I'll jump into our diagnostic. Like I said, I did do the site visit. I asked Emily a lot of questions, so I wasn't just taking a stab at it. I really got to know the risk first. On your property policy, you have a $25,000 water damage deductible. You have a $5,000 all other perils, but the $25,000 water damage deductible is tough to reach when you have those water damage incidents because you're only covering drywall out. So we like to see that reduced. We like to see it be 10,000 or be 5,000 and match the all other perils deductible. You have a limited limits. You have a $25,000 limit for the fungus and a $25,000 limit for the backup. We like to see those be at least 50,000. The mold, maybe you could get by, but whenever I see a sewer backup, that means dirty water. And when there's dirty water, it's nasty, it's expensive, it's disgusting. It's probably going to cost more than $25,000. So $50,000 are up for sure on the sewer backup. You've got $100,000 in wind-driven precipitation. If there was to be a windstorm outside and it did not pierce the envelope of the building, but water came through, it squeaked through the seals of the windows and damaged the drywall all the way down the side of the building, that's called wind-driven rain or seepage. That's why you have a separate sub-limit. So your full $133 million limit is not applicable. You've only got $100,000 in coverage. For buildings as tall as these are, those drywalls you have on your facing the east and facing the south, where the storm may come from, we like to see at least $250,000 in wind-driven rain. Equipment breakdown, you guys have $100,000 in extra expense on the policy. The problem with that is that equipment breakdown is for unexpected arcing. If there's a lightning strike, that's a property claim. If there's unexpected arcing, that's an equipment breakdown claim. That's going to go through your equipment breakdown policy. If that happens to your air conditioning, which happened with Emily and I at prior property, the air conditioner went out due to arcing. We had to get equipment in there. We had to get diesel. We had the diesel running equipment to cool all the hallways off. The extra expense to run in that equipment for a couple of weeks was well over $100,000. And that was a much shorter building than these are. These are much taller buildings. So if your air got taken out and you had to get that equipment, you would need at least $250,000 in extra expense on your boiler machinery. And it's not that much money to make some of these changes that I'm talking about. So what we do is we'd always say, here's apples to apples on your property and your equipment breakdown, and here's what it costs to make these changes. So there would be no upsell. I'll be like, here's A, and here's B with these options. The general liability is not the agent's fault. Right now, the liability carriers are sneaking a lot more exclusions in on the policy than they did in the past. Your master policy has an abuse and molestation exclusion, a liquor, and a communicable disease exclusion. You're not going to be able to get those waived. We try to look in the marketplace and say, let's bring apples to apples. Here's the renewal. Do we have a policy especially that doesn't have the abuse and molestation? Because you can't help it if abuse and molestation takes place on the property. You certainly don't want to have a claim be excluded and have no defense. If it was too much money to replace the policy, we would say, let's get a legal defense policy, a couple $1,000s. So if something slips through the cracks because of abuse and molestation or another exclusion, we have unlimited defense with your legal defense policy. So how much does it cost to replace the policy and how much is it for the legal defense? You can vote which way to go. Your south tower, you have a $5,000 bodily injury property damage deductible. Right away, we always try to separate that and say, why is it $5,000? It shouldn't be for bodily injury and property damage. It should be for one or the other. And on top of that, we like to see that at least cut in half. I looked at all of your loss runs. They're not that terrible. They're average for these types of condo associations. So we need to try to find either a break on this carrier at renewal time. This is with Kinsdale, but they may not give you a break, or we need to replace Kinsdale.
The problem with Kinsdale is they have water damage exclusion, named insured versus insured exclusion, firearms exclusion. Those three things we have difficulty with in condo place. You have water damage incidents, if a homeowner's carrier comes after the association afterwards and says, I think you're negligent, and they subrogate, you've got no defense with this policy. So if we can't replace the Kinsdale policy because it's prohibitively expensive, let's get the legal defense policy. At least we have somebody defending you from frivolous suits, and you don't have to get the attorney to defend on you. The North Tower has a $2,500 deductible on that policy. That's not too terribly bad. We'd like to cut that down to 1,000 or 500, and eventually get that down to 0. The same thing with the exclusions, but this guy also has an assault and battery sublimit. Your policy has $1 million per occurrence limit, it's a $2 million aggregate, but they deliberately gave you a sublimit with $250,000 if there's assault battery on the premises. And you can't plan where an assault battery is going to take place, so you don't want to live with a $250,000 sublimit. You want the full limits and then the umbrella kick in after that. If we can't replace that, we would say, here's your apples to apples renewal with these same sublimits, hopefully a better deductible. Here's what it costs to replace with the new carrier. Here's what it costs to get you the legal defense policy. So this way you can vote to have better coverage. And if they add more exclusions, because they're adding more exclusions in this year, it's even more reason to have that prepaid legal defense policy. It's a few $1,000s. So if you would have one claim where you had to hire an attorney to write demand, look, start defending you, you can go over a couple $1,000s pretty quickly. Your directors and officers policy has a $50,000 retention. The good news is they have a duty to defend you. So if the board members made a decision in the South Tower, and later on someone said, you know, I don't like that decision you made about the parking spot or my animal or whatever, and they threw a suit out, they would defend you, but you're on the hook for up to $50,000. So if the attorneys had to pick up the case and there's a $25,000 legal defense case and $10,000 indemnity, $35,000, you have to pay it because you got that $50,000 retention. So we don't want a $50,000 retention on your directors and officers policy. More reasonable ones are like 5,000 or less, 2,500 or 5,000. So that's something we need to work on. We talked about the legal liability policy. So if there is some reason that a claim is denied or it slips through the cracks for your general liability or your directors and officers, you have unlimited defense with your legal liability policy. We'd like to see what would it cost for the towers separately and the master, and then can we get one for all three? And we have 2 different carriers to shop it out. So we shop it out several different ways for you. The crime policies, I didn't have enough chance to get back to Emily yet. I want to make sure that you're compliant with statute, and also consider adding a $5,000 investigative expense with 0 deductible. The reason I like to see that is if money is missing, we don't want to worry about your policy directors. I want to say, let's get a forensic guy in here and see how this money went missing. And then if it turns into a claim, then we'll look at the deductible of the policy. If it doesn't turn into a claim, because it turns out that the bank covers it, we want you to have 0 deductible during that forensic work. So just small things can make a big difference on your program as a whole. And I'll probably stop with the coverage review, and I have hard copies I'll leave behind as well. And on fee structure, I'm always a big fan of he who's greedy goes home needy. I'm not a greedy person. If I had an idea of what you did last year, I'd like to see if we could match that. We don't generally charge a fee. The carriers pay 7% to 10%, depending on the line of coverage, except for flood, they pay a little bit of a higher percentage. But if you guys had some kind of agreement that you worked in the past with the agents, if you could let me know what it is, I'd like to take that to management to try to meet. Open it up to questions for you guys.
I'll go first.
Sure.
Thank you, great presentation. Thank you for analyzing all our policies. And you seem to have kind of uncovered some potential for improvement. Some of the policies where we could have lower deductibles, higher limits, and to protect us better. So thanks for that.
Sure.
What I would like to ask you is specifically here into the property, which includes wind, which is kind of the, as we know now, the bulk of our annual premiums that we pay.
Mm-hmm.
How could you go about improving, or can you improve the quotes that, for example, Lockton, our current agent, is obtaining or has obtained, given the fact that there is only a few number of carriers, there is all these challenges. Help me understand how you can come in and lower our premiums next year.
Okay. Other than the changes on the current program, What we could also do is we have a probable model loss that we have access to. We could say, what would the probable losses be if various hurricanes came through? If you got $133 million worth of garage and the 2 towers, what could happen? We always want to keep you with $133 million full limits, but we always also want to say, what if they were insured for 50 million, or 60 million, or 75 million? Not just what does that mean in premium dollars, but with these models, what's the likelihood of suffering those kind of losses? And I think having those models and then seeing the loss limits, you can make a decision, an informed decision to say, you know what, we saw the wind models, we're scared, we're staying with our current program, we're staying with 133, you can say, you know what, we saw the wind models, we're comfortable with 85 million or whatever other number you might come up with. Let's go with that for this year, because if we don't, we're getting crushed by the premiums. We did make a few phone calls, and we did talk to underwriters, and we found out that unfortunately this program was non-renewed. They are setting up a renewal file, so you're going to get one, but it's probably going to come in a little bit more expensive than you might like. So it's important to have out of the box other ideas to look at, other suggestions to look at. If you say, you know what, I'm just too scared, I look at this problem models, we're staying with this one, at least I brought you all options, out of the box options, and your renewal, and hopefully improvements to your renewal if you stuck with the renewal as well.
I didn't quite understand when you said that this is the current month policy was not renewed or was not extended. What did you mean by that?
Right, Emily, did you get a non-renewal for that? Okay, when we called the underwriter, they had mentioned that a non-renewal was sent out in like February.
To which, so from our current carrier?
Well, they're all sending out standard non-renewals. Everyone is non-renewing. It's just a question of what are the terms going to be when they offer the new policy. They're going to have, a different carrier. We're going to have Princeton and whatnot. They're going to use a different carrier lineup. Are they going to stick with a calendar year? Or are they going to stick with per occurrence? Are they going to give you 10,000 for the perils instead of 5? So it's going to come in different.
That non-renewal letter simply states that, hey, the terms that you had last year, there's just too many changes in the terms, so we're not going to renew what you have.
Exactly.
Come back to us, basically, and we will give you completely new terms, maybe higher deductibles, et cetera, et cetera, et cetera. Is that what that?
Yeah, I know you don't want to get that news, but that's what's going to happen.
Okay.
And that's what I'm saying, that's why it's more important than ever to get the other out of the box ones. Maybe we can find something with, a loss limit that's got a calendar year and yours is coming in with a per occurrence. And then we'd say, okay, here's what a per occurrence means with 5% or 3%, depending on what they're offering. We'd say, here's a dollar amount that you can be stuck with per occurrence every single time the wind blew, versus this one's a calendar year. It's higher at 5%, but it's only one time in the calendar year you could suffer that loss. So it's important to have the out of the box and the in-box solutions and put them side by side. And to have the probable model loss so you can look at it and understand what kind of damage could we suffer if various category windstorms came through.
I'll answer that question.
Okay.
So would it make sense for us to basically assign you 10 of the carriers that maybe Lockton doesn't think they can get good results from, and can you go to them and then try to give us kind of a competitive quote because we're brown and brown, and you can get us, a better deal, better policy, better premiums.
Yeah, unfortunately, in this marketplace, I'm going to back it up maybe 2 steps. I did mention we had a meeting with some folks earlier. We lost 12 property insurance carriers. We had 3 really key ones leave the area, and you were with one of them ever since the past. There isn't that much competition. And this year, what you really want to do is you're going to find out, who do I want to be my agent at renewal time? I know it's kind of a cruel thing to say, but you would need to, between the 3 of us, you're going to need to pick one, and you're going to say, especially for the property market, especially for the umbrella market, they're just going to have the whole marketplace, and you're going to have to trust that they're going to say what they do and do what they say. But if you pick someone other than your current agent, or if you pick your current agent, put them on a short lease. If someone says, hey, I can bring you probable model losses, say, okay, bring those to me next week, Wednesday, and let's go over them together. Have more frequent meetings, and then, if that person is performing, keep them with the markets. If they aren't, you can always rescind and send them back to the current agent. There is a 10-day wait with that Sigma property program. So whoever is your agent, when you're within the 10-day window, is gonna be your agent.
And, somebody has questions, I don't want to continue asking.
Sure.
So our previous agent, our current agent, Sean from Lockton,
Mhm.
he explained that our current carrier, will not issue any type of, quotes until 20 days before, which is happening in the next 10 days. Is that common is that?
Yes, it is.
It's common.
It's common, absolutely. So if you wanted, you could think outside the box and say, I'm gonna give Brown and Brown all the property markets except for my renewal carriers. And let him come in with the renewal and see how that comes in, and let Brown and Brown have the rest of the marketplace. That could be a possibility. That's a little bit thinking outside the box as well. So two different ways you can do it there.
Any other strategies that are just creative, that is one that you mentioned?
Unfortunately, for the property marketplace, because there's only gonna be one person's gonna have the layered programs, one person's gonna have the Sigma program, and you got $133 million total insurable value that not very many carriers are even gonna reach that capacity. There isn't room for a third person, it just won't happen, guys. And really, ideally, you wanna pick one person, set milestone dates, stay on target, and renew with one agent. And if your current agent is doing a good job, I wouldn't want to waste everyone's time. At least I helped to educate you with this coverage audit and gave you an out of the box idea. Maybe he can bring you the probable model loss model as well. Stay with him, let him bring that to you, and keep him on a short leash. Got it.
Hi, William, thanks for your presentation today.
Sure.
I'm curious to know what other, I know like the for 1800 club, you're the broker for.
Yeah, Joe and I was on 1800 Club and on Sit Day.
And is that the two buildings around this area?
Yes. Yeah, and then Sharon at Sit Day knows me well, and Hassan over at 1800 Club knows me well, because I've worked with both. So if you needed a reference, you can feel free to reach out to those guys.
Yeah, I already did, I reached out to.
Oh, which one? Oh, Anna, okay, yes, okay.
So I hope that you could see what your savings that you could do for us.
I would crush the market hard if I was to be your agent, I would like to ask for all the markets to do the job properly. To bring back at least a correct program and an out of the box program, to have all the resources. I wouldn't want to split it and do a halfway job. I want to do the job all the way correctly. I'd rather either A, let the current agent, the other guy have it, or B, let me have it. I just wouldn't want to do a halfway job. That's my preference. I'm a hardest in the right place. And I've been doing condos since 2009, and just so you guys know, this is all I do is condos. If somebody says, hey, I got a bakery or whatever, I'll refer them to somebody. I'm happy that they thought of me, but condos and associations, home association, that's what I do. It's my passion. It's my thing.
Thank you.
Yes, sir.
Thank you very much. It's not a question. This document exists, you have a copy?
Yeah, I have a copy here. In fact, we just bring it to you guys now, if you don't mind. I wanted to go through it with you guys. I felt like nothing personal, but if I hand something like this out, everybody flips and nobody will watch it.
You're absolutely right, that's exactly what happened. Thank you, sure. Can we flip now or?
Absolutely. Love the story, man.
Yeah. Absolutely. Hey guys, Emily has my email and myself and my number, so if there's any questions tomorrow, 2 days from now, whatever, please get up there, please reach out to me. Is our area for going to vote for raise that way? Currently, yes. And that's for both towers and the garage. See what else you do, Lester?
You did not talk about the rate increases, sorry.
Yeah, rate increases, we touched on it at the previous meeting, because I know that non-renewal was issued. At the previous meeting, I did mention the 35% might be the number that we had spoken of, and it could be possibly higher. I would hope it would be higher. I'd do my best to push it to be as low as possible. The reason that I feel it's gonna be expensive is because it's $133 million that we have to find insurance for. That's tough to do. Until I get the agent of record letter and get out there and look at the excess surplus market, some of those are only 5 days to clear. After 5 days of receiving an agent of record letter, I could have the 6th day, I could have another meeting and say, here's my initial findings 6 days later. So that's something I could bring to the table. But I would need 6 days, 5 full days for the clearance, and then the day to get together and come out late like this, 6 days and late in the day. Go ahead, ma'am.
You roll the tape back 1 second, you said 35%, is that the overall of all the policies that we would have to have?
Of the bottom, I'm saying bottom line, it could be a 35% increase.
That's what I heard.
Okay. Because I know you don't want to hear that, so I would like to go to work and try to do better.
We keep hearing 30 to 40%, so.
It's in that range. Everyone's saying the same thing. No one's misleading you. Yeah, no one's coming in and saying 5% because they're gonna be fired because it's not gonna happen.
Thank you. Thank you.
Any other questions? All right. There's all my stuff here.
Yep. Thank you very much.
Thank you, everybody. Have a good night.
Close that box so it's easy to carry.
That's my mom. We'll fix it. Thanks, guys. Thank you for the reference. Thank you.
And that is all we have for insurance. Thank you very much.
Thank you.
Thank you, everyone. Have a good evening. Bye-bye.